Our argument is that the key to understanding turning points is understanding the dynamics of the core, and for this to be most useful, we need to capture the market's perception of the dynamics of the core, and from this form a global perspective. One way to build understanding of the future is to build a map of where we are now. In a sense, the market is always looking at the US, China, the Eurozone and oil on perceived expansionary, contractionary dimensions, with the perceived extremes or polarities varying with the economic realities of the time. Articulating the perceived polar positions on the expansionary, contractionary dimensions allows us to judge our current position, as well as the overall conceivable shock space. Possible shocks and potential risks and their impact can then be superimposed to assist scenario development. The map provides a tool for thinking through the future and a way of articulating the past. As an example, we consider the US, the Eurozone and China in mid-2011. For the US, our perceived negative extreme was a deflationary spiral, and the positive extreme sustainable on-trend growth, with an actual position close to unconvincing recovery despite extraordinary policy support. Clearly, the polarities here are unlikely outcomes. They represent our perception of the anchors around which both investors and policymakers organize their directional thinking. For the Eurozone, the negative extreme was Eurozone breakup, and the positive extreme comprehensive debt crisis resolution, with the actual position close to insufficient policy response. For China, the negative extreme was a hard landing, and the positive extreme disinflation, with the actual position close to incremental policy tightening. Putting the two primary dimensions together, i.e. the two dimensions with the greatest impact on prices, produces the map. The way in which the dimensions drive global prices can change according to circumstances, rotating between periods of high interaction and combination, or periods where one theme dominates with the others lying in relative dormancy. The map is arranged so the top left corner is the expansionary extreme and the bottom right corner the contractionary extreme. Shocks moving macroeconomic activity towards the top and left are likely to be risk-on in orientation, and shocks moving activity towards the right and bottom are likely to be risk-off orientated.
As an example, we use the map to describe the core's dynamics from the middle of 2011 until the start of 2012. We start with a macro position based on the intersection of the US and Eurozone dimensions, these two regions being the primary market drivers at the time. Despite the relatively stable macro position, markets exhibited extreme immediate term reversals, discounting actual or perceived positive or negative shocks in the US and Eurozone, with the Chinese dimension lying in relative dormancy.
These dynamics were terminated by the US debt ceiling debacle of August 2011. The main effect of the US debt ceiling scare was to bring the issue of sovereign insolvency to market consciousness, but with the focus shifting from the US to the most pressing reality, the Eurozone periphery. The US's flirtation with fiscal suicide in effect meant that markets were no longer prepared to give the Eurozone's periphery the benefit of the doubt, leading to progressively worse sell-offs in the sovereign debt of the periphery. In the Eurozone periphery, austerity policies combined with bailout policy intransigence and insufficiency to lead to major sell-offs in government debt, thereby pushing up government funding costs to unsustainable levels and engineering a growth slowdown, thus exacerbating the underlying problem of reducing budget deficits that austerity policies were supposedly addressing. In essence, a Eurozone contractionary policy lock had created a negative growth spiral spreading out from Greece and Portugal, and by the time these dynamics reached Italy and Spain, the crisis and the insufficient policy response to it had begun to pose a credible threat to the euro, and because of this, a major threat to the world's economic system. With no policy flexibility in sight, Eurozone breakup became a progressively more realistic possibility as 2011 drew to a close. Risk assets sold off globally, particularly in export-dependent Asian markets. Correlations rose both within and between asset classes, indicating a serious increase in systemic risk, and the Eurozone's policy news flow dominated financial asset markets globally. In December 2011, the ECB announced the ELTRO program, supplying 3-year liquidity to Eurozone banks, thereby relieving the contractionary policy lock. This acted to suspend the negative growth spiral, as an ensuing credit crunch linked both to the poor lending outlook and the requirement of Eurozone banks to boost core capital to 9% by mid-2012 appeared to have been averted, combined with the possibility of support for sovereign debt from banks using the ELTRO facility. The move introduced some necessary policy ambiguity into the Eurozone's policy mix, which had begun to look like a one-way bet, as well as buying some time for supply-side reform to get established in Greece, Portugal, Italy and Spain. The ELTRO move, plus the gathering evidence of some more sustained growth in the US, has produced a significant risk rally, with the concerns of a Eurozone economic disaster being significantly demoted. The main effect has been to reverse the dynamics of the Eurozone bond run and policy insufficiency spiral. The Eurozone may still come back to dominate global pricing, as national insolvency issues are far from solved, but the possibility of growth momentum building in the US, plus an improved policy game from the Eurozone in 2012, makes Eurozone contagion risks look significantly less important. This brings us to the current market position, and the perennial trillion-dollar question is, as always, what next? We do not attempt to answer that here, as clearly that is beyond the scope of such an introductory video. Our point is simply to demonstrate the extent to which shock has recently dominated world financial markets, and hence the importance of contingency strategy.